Okay, casualty losses. Now, this is a real thing. Virtual currency loss is a real thing. In part one, we discussed a number of virtual currency disasters that have caused millions and millions of dollars of lost currency. So if an exchange goes under and your client loses virtual currency, how do we report it? What are we going to do with that? And there are other ways of losing virtual currency. Someone walks into your house and steals your laptop along with all your virtual currency keys. Then what? Your insurance company typically will reimburse up to $200 of lost currency. If someone breaks into your house and steals cash, the average insurance company will reimburse up to $200. So, picture yourself calling the insurance company and saying, no, the IRS says it's property. I'd like to be in on that phone call. All you're going to get is reimbursement for the computer that was stolen, but that's it. So what do we do with losses? How do we file them on a tax return? I think the safest thing to do is, even though we don't like it, is to report it as a casualty loss or a theft. And as we know, that's an itemized deduction subject to the 10% and $100 restrictions. Now, if it was a worthless security, we would report it on Schedule D, right, which would be a capital loss and potentially negate capital gains, and you wouldn't have to itemize to take advantage of that. And I've heard this argued both ways. So, I don't know. You might say it depends on the situation. I certainly think that the safest thing to do is really to go ahead and report it on 10% as a 10% casualty loss. I'm sorry to say it. Is it a lost bank deposit? Well, no, because it's property. So it's not a lost bank deposit. It's a lost '67 Chevy pickup. So I think that the best practice is going to be to report it on Schedule A. Now imagine this horrible scenario: your client buys Bitcoin, trades it for Ether, triggers a capital gain, and then the exchange is holding his Ether goes under. So what has happened is that your poor guy now has taxable gain, okay, from his Ether trade for Ether, but the money that he had is gone. So he doesn't even have the money to pay the tax. So it gets us into some unfortunate situations here. But I've really thought about this hard. I don't really see a great alternative to claiming the loss on Schedule A. If you do decide to go ahead and put it on a Schedule D, I would certainly add a disclosure statement saying that that this is what happened, that the exchange went belly up. I'm reporting it on Schedule D and see what happens. But at least that way there's not a tax fraud issue. You have disclosed it. Foreign exchanges. This is another fun topic that we don't have a ton of direction on. So here is what we know about foreign accounts. The IRS tells us if we have a financial interest in or a signature authority over a foreign financial account, such as a bank account, brokerage account, etc., and they say or other type of foreign financial account, that you need to file an FBAR. So what we all know is that if you've got $10,000 or more in a foreign bank account or brokerage account, that we have our clients file an FBAR. So the question that we have is, does our offshore virtual currency account, is that considered a foreign bank account? So if I've got $10,000 sitting in a Japanese account, Japanese foreign exchange, do I have a foreign bank account? Okay. Now, it's very much not clear. The IRS has issued guidance stating that foreign virtual currency exchanges are money service businesses. So, okay, so if I've got money in a Japanese exchange, that's a money service business. So in that case, is it property, which IRS, you told me it was, or is it currency because it's sitting in a money service business? I don't know. I'm very confused. So to make things just a little more interesting, the IRS, in 2014, an employee of the IRS, said that for FBAR purposes, Bitcoin is not reportable at this time. Now, it was never put in writing. It was stated. No further guidance has been issued since. So, I just picture the IRS issuing some more guidance and saying, oh yeah, and if you didn't do this in the years where we didn't tell you to do it, we can still charge you penalties. And the penalties for not filing an FBAR if you needed to, if it's 50% of the value of that foreign account, I mean, the penalties are horrific. It's not like a couple of dollars. I would say the best practice is tell your client to file the FBAR. If they choose not to, that's fine. That's on them. But I would certainly want to be in the position of having told my client that an FBAR was the safest route. That's how I would want to be setting up that one. And it's not like they're paying tax. I mean, the FBAR is just a form. They're not paying any tax. Okay, IRAs. Yes, guess what? There really are IRAs that invest entirely in virtual currency. This is very new stuff. This is all, this is just exploding like mushrooms after the rain. And you know what? You treat it just like any other IRA. Your client comes to you and says, I put money in, in bitcoinira.com, and you go, that's great. How much did you put in? That's all you care about. It's exactly the same as any other IRA. It's the dollar value, of the contribution at the time that of what the contribution that they made is what they get to deduct. And if they took Bitcoin and bought directly into the IRA, then it would just be the dollar value of the Bitcoin at that time. So just like any other contribution. Now, Section 1031 exchanges. We have investors all over the place that are just so excited by this concept that they can swap Bitcoin for Ether or anything else, and they don't pay tax and people have assured me very seriously, no, it's a like-kind exchange. And I keep trying to say, well, no, it's not clear at all that it's a like-kind exchange. It's in fact very unclear that it's a like-kind exchange. So Section 1031, if you haven't bumped into this, it allows like-kind exchanges of specific kinds of property. And what we mean by that is that, like I have a rental house and I'm going to trade it for another rental house. And what I'm going to do, rather than pay tax on the gain at that time, is my basis is carrying forward into the second rental house, and I won't pay tax on that until I sell the second rental house, or however many times I've exchanged it when I sell that final rental house. Okay, so that's the concept. Now, Section 1031 specifically excludes securities because obviously you don't get to trade AT&T for Comcast and not pay tax. You don't get to trade securities. Now, certainly virtual currency is not a security. There's no ownership interest. But it's still not clear that Bitcoin is like-kind to Ether just because they're both virtual currencies. For example, we had a revenue ruling, 79-143, that stated that the exchange of U.S. gold coins for Krugerrands were not like-kind. When you would think, well, really? That's about as like-kind as you can get, 2 gold coins. But no, the IRS says that that one is collector items and the other is bullion. And collector items and bullion are not like-kind. So, they've got a different way of looking at things. And on the other hand, Mexican 50 peso gold coins could be exchanged for Austrian 100 Corona gold coins because they're both bullion type coins. Okay, so you could certainly picture the IRS saying that, Bitcoin software is really different from Ether software, so the 2 coins are not like-kind. Who knows, all right? But I think that counting on like-kind exchanges is a mistake. And certainly if you ask these people who have been relying on like-kind exchanges all this time, did you file Form 8824 recognizing the like-kind exchange in the year you exchange it? And there'll be this long dead silence because they never heard of that. They just had this idea of like-kind and they went with it. But we as tax preparers know that no, there is not a like-kind exchange if you did not file Form 8824. So yeah, a lot of people are getting themselves into trouble here. If you do decide for whatever reason that you're going to let your client use Section 1031, you have to include Form 8824, and I would definitely put in a disclosure statement, and I would definitely be telling this client that if the IRS issues additional guidance specifically prohibiting these exchanges, that tax return will have to be amended. Okay, I think best practice is just report the trades as a sale and subsequent purchase, just as if client has sold stock A and purchased stock B. I think that's the safest approach for us. Okay, initial coin offerings. People are talking about ICOs a lot, all the time. You're going to hear this term a lot from your clients. This is the latest and greatest mad investment opportunity, okay? Remember we used to hear a lot about IPOs, and then now we have ICOs. These ICOs are raising millions of dollars in just minutes. What this is the creation of new digital currencies. For example, Basic Attention Token raised $35 million in 30 seconds. Aragon raised $25 million in 15 minutes. Something called Status.im raised $270 million in a few hours. So what this is people are creating new coins. They're offering the new coins at smoking deals, and people who are remembering the lessons learned from Bitcoin and Ether and Litecoin are jumping on the bandwagon like crazy, hoping to get these coins for a couple of pennies, and then a couple of years later, have them be worth thousands of dollars. So you can understand why people are very excited about it. So people ask me a lot, so I participated in an ICO. Well, what does that mean? And it's like, well, it doesn't mean anything, because, it's just like anything else. You have paid however much you paid for these new coins. That's your basis. Hopefully you've documented it somewhere. And you may lose a lot of money, you may gain a lot of money, who knows? And the only thing that there is to know for these clients is record your basis and the date that you got involved in the ICO. Okay, finally, tax resolution. So it's going to come a time when you're preparing a Form 433 for a client in tax resolution. And virtual currency, of course, is just an asset with the value equal to the fair market value as of the date of the application for when you're signing Form 433. Now, the Internal Revenue Manual allows for reduction in the value of assets for a quick sale, but it's certainly not clear that virtual currency would fit into a reduction in value. I don't think you'd get to reduce the value of it for a quick sale, because honestly, you could sell it in 3 minutes. On your exchange. So why would the IRS allow for reduction in value? You might be able to ask them to make a reduction for the amount of tax they'd have to pay. The taxpayer would have to pay if it was sold, and that might or might not fly.